Thank you, Mr. Mashila. Good afternoon, colleagues, and welcome to the final webinar of the year. We're very excited to have you, and we're excited to have this presentation. Mr. Mashila, I'm going to hand over to you to introduce our guest. Thank you.
Thank you very much, Anita, and good afternoon, everyone. My name is Boitumelo Mashilo. I'm the head of the Infrastructure Advisory Services in GTAC. And today I am joined by two esteemed colleagues. The first one is Vadim, who's the director, the head of participation guidance in international infrastructure formats, the Agent's Office of the State Development Corporation, VEB, in Russia, together with Veron Vukeya, who is a senior analyst within the Capital Projects Appraisals Unit in GTAC. And today, we are talking about a topic that a lot of us are familiar with, which is blended finance. This is not a new topic, I suppose, in South Africa. But of course, our understanding of it is different depending on the context or application. So this is a topic that we introduced within the BRICS task force on infrastructure and PPPs 2 years ago when we were chairing the committee. And it's a topic that we are also carrying through into our infrastructure working group under the G20 presidency. And the long and short of why we are interested in this topic is because, within a context where there's significant fiscal constraints, particularly in emerging markets and developing economies. A lot of countries are encumbered by high debt levels and so on and so forth. So a decision has to be made whether you wait for the time when you have sufficient public resources or you take advantage of the opportunities that lie in the capital that can be provided by the private sector. And in this regard, blended finance does hold a significant potential for bolstering investment flows for infrastructure development. It really allows the governments to mobilize financial and non-financial instruments, solutions, products, and mechanisms to de-risk projects, thereby enabling additional private financing and crowding in greater private sector participation in public infrastructure. Because for today, we are going to have Vadim and Veron unpack this topic for us based on a report that has been concluded under the Brazilian presidency. And really drawing on the application of the concept of blended finance across the BRICS countries. And how we are going to run the session is that Vadim and Veron will have close to an hour. It's less than an hour, but close to an hour, 40 to 45 minutes just to go through the presentation. Vadim will be talking about the topic at a high level, but also talking about the experiences of the different countries. And then Veron will be talking to us about the specific application of blended finance in a specific project in South Africa, the OMMMP, which is down in Limpopo. And then after that, we will have a question and answer session, but people are more than welcome to raise their questions on the chat while colleagues are presenting. With those words, let me hand over to Vadim. Vadim, over to you.
Yeah, thanks, Boitumelo. Hello, everyone. Thanks for having me. And Boitumelo, it's a Russian presidency under which the technical report on the blended finance of infrastructure projects has been prepared. But the Brazilian presidency in G20. And talking of that, I would like to congratulate South Africa with taking the gavel of chairman ship in G20 for the next year. So it'll be a very interesting time, and I know that the blended finance will be also one of priorities for South Africa, and it's very interesting because we see how trendy that topic is. So I'll start with a few preliminary words, and then we'll jump into my presentation. The blended finance topic itself has a long story, but the description, the details of the concept has been outlined quite recently. Initially, the official development assistance as a way of development finance channeling was sort of a cradle for the blended finance concept, because the aspect of foreign element in investments is very important for blended finance. But of course, blended finance transactions may be done without the foreign investments component. So Karl Popper, the philosopher of the 20th century, he was a big fan of idea of interdisciplinary knowledge and interdisciplinary approach towards understanding things and bringing synergy. And blended finance is sort of a embodiment of Karl Popper's concept of interdisciplinary approach in terms of sources of finance, because blended finance is based on the main aspect where you take the finances from. It may be public finance, it may be philanthropic, it may be private. So, which is why PPP may be also referred to as not public-private partnership, but public philanthropic partnership, private philanthropic partnership, and public-private philanthropic. So PPP has very another interesting interpretations of that abbreviation. The blended finance as I'll beam the presentation. We chose the Russian Federation chose blended finance as a priority topic because we saw a great potential out of the South African's presidency in 2023 in BRICS, and that idea was initially taken as a priority by South Africa in a short aspect, and we decided that we will inherit and continue to develop that topic. And now we know that that topic will continue to develop in G20. And the main outcome of our work during this year was the technical report on infrastructure projects blended finance. I urge everyone to get familiar with it, and I hope that the organizers will share it with all the participants of our webinar. And what we have taken out of that report on a general level out of that study is and what it helps to understand that study, that in that report, you may find a basis for a common BRICS understanding of blended finance, its principles and characteristics. It's very important because when we refer to blended finance, depending on the context and depending on application, as Boitumelo rightly pointed out, it may be differently understood. So to have a common understanding of what is blended finance is very important in order to have a common language and also the support measures and regulations. So that report helps to enable the selection of most appropriate composition of actors. That is also a very important part. We'll touch on it later in respect of who practically blend the finances, who participate in that transaction, and that's also a crucial part. Financial and non-financial instruments also a very crucial part. Mechanisms, PPP, some have a point of view that PPP is not blended finance. The others, so academics, they have a deviating view. Some believe that PPP is not part of blended finance. The others believe that PPP is a subset of blended finance. So from my point of view, we think that PPP is a subset of blended finance, and it's a mechanism which may be used to blend finance. So that technical report provides an inventory of the current barriers and challenges of blended finance. So most of them are quite universal, but some of them are specific for the blended finance, and we'll touch upon it later during the presentation. And of course, what we found during our study is that national development banks, and I representing National Development Bank, and we have a very good relations with DBSA, South Africa Development Bank. The national development banks, they play a very important role in facilitating blended finance transactions, apart from providing concessional capital, but also serving as a technical assistance providers. During that study, we collected 8 surveys from 8 countries: South Africa, Russia, China, India, United Arab Emirates, and so on. We collected 9 multi-sector case studies from different sectors, and the case study which will be presented by Veron is also one of the case studies which we used in the report as a source of knowledge. And that technical report was not only adopted by the task force, but also endorsed by the BRICS leaders, meaning that the head of states endorsed that report as a very important outcome of the BRICS work during 2024. So the structure of the technical report is quite simple. It is divided into theoretical and practical aspects: introduction, the section on defining blended finance, what's the definition, the list of actors and description of actors and their roles, which blended finance instruments and mechanisms are used in practice, the challenges and barriers of blended finance, which preclude or let's say stop from scaling up blended finance for financing infrastructure projects, and conclusions and lessons learned. What is important is that blended finance is a broader concept than just financing infrastructure. Blended finance may be used in a variety of ways when you understand that the public budget is not sufficient enough to finance some sort of activity. To understand blended finance, one may come up with let's say an example of a young adult planning to buy a real estate, planning to buy an apartment. So what sources of fund that young adult may possess? First, his own funds. Okay, so let's say it's a public funds. Then some part of necessary finances may be given by his parents. And they have no interest rate, but they have interest in social impact, because he will buy apartment near them, and they will be able to be with his and her children, grandchildren. So that's a philanthropic source of funds without zero interest, with zero interest, but with interest in social impact. And then comes the commercial banks providing a commercial loan. That'll be a participation of private source of funds. So with that oversimplified example, you may see how in practice we all touch blended finance in our daily lives. But if we apply that approach that I have just came up with, it means that almost any action may be treated as blended finance. So there are some distinctions. What is actually may be referred to as blended finance and what is not. In the introductionary part of the report, we touch on a few aspects. So blended finance is an emerging trend. Why? Because blended finance allows us to expand fiscal space, allows us to mobilize private capital, and everyone knows that mobilization of private capital is a very important topic these days, because states admit that infrastructure may not be fully implemented only with a public budget. So participation of private parties is very important. It's in a way it reminded me of AML CFT concept, anti-money laundering concept, when the states admitted that they need participation of commercial banks through compliance to implement know your customer procedures to sort of serve as law enforcement agencies. The participation of private sector these days is not only important, but it's natural and logical. This private sector now is intertwined with the social activities, and we see it also through the concept of ESG. And that's the second aspect of blended finance, that blended finance usually should be directed, and the project which is financed through blended finance approach should be facilitating achievement of sustainable development goals. That is an important aspect. Also, blended finance targets emerging markets and developing economies. That is also an important aspect. Of course, it doesn't mean that you cannot do blended finance transactions in developed countries, but the core aspect why blended finance is now being pushed further and supported by multilateral development banks and other development finance institutions, because it is very practical and practical for the purposes of tackling and addressing challenges of emerging markets and developing economies. So blended finance is ours thing, because Russia is also in AMDEs. Mobilizes private and philanthropic capital, it's quite obvious. I've talked about it already. Supports infrastructure development and expands fiscal space. So why it is important to have a common understanding of blended finance? I'm partially a lawyer, and for me it's always important to understand concept in a written form, because when the initiator of project, the donor, the operator of project will have or may have a different view of what is blended finance, it will be quite problematic to draft an agreement or other legal instruments which will be used to channel the finances into the project or a special purpose vehicle. So everything starts with a definition, like in Holy Book, everything started with a word. So here, everything starts with a definition. But an interesting outcome of our study is that blended finance may be carried out and is carried out without having a definition. So definition is an optional thing, but a very useful one to help you to sort of highlight and separate transactions from one and another. And also it helps for transparency, accountability, builds a necessary foundation for communication, etc. So I believe, like in the green taxonomy, what is the purpose of taxonomy is to have an album, a catalog of criteria to identify a specific projects which may be attributed to a green projects. And the same thing is with blended finance. You need a definition, you need an understanding what is blended finance to better identify is certain transaction falls under the scope of definition or not. And what are the approaches to definition of blended finance? There are different approaches, and we will touch upon it later. Of course, we understood that it's important not only to come up with a description of what definitions we have in place now, or we can utilize, but also what are characteristics, principles, and terminology used in the context of blended finance. And it's very important because sometimes definition is not helpful enough, or it will be very cumbersome to apply it, because there will be a lot of details in that definition legally wise, which is why sometimes principles according to which the transaction is carried out or drafted, may be more useful to understand whether a certain transaction may be referred to as a blended finance transaction or not. Well, in our scope of study, characteristics and principles, they are quite similar, but we will see them later. And of course, we understood that it's important to see what's happening in BRICS countries in respect of defining blended finance. And mm, the news the news is that there are no one from BRICS countries have a legally set definition of blended finance yet. So there are some activities carried out in terms of preparing draft laws, using sub law or lower level legal act than law to come up with a certain understanding what is blended finance. But presently, BRICS countries doesn't have any like federal law with a definition of blended finance, and all of BRICS countries have their examples how blended finance is utilized in practice. So everything started with Addis Ababa Action Agenda in 2015, and the United States definition is a short and simple one. Of course, it's in my view a bit outdated. Financing that combines concessional public finance uh, with non-concessional private finance and expertise, which means technical assistance from the public and private sector. We don't see any philanthropic aspect here, and we see that public finance is tied to a concessional aspect. Sometimes it is not a prerequisite for public finance to be concessional. So then the OECD took the flag and started to dig deeper into the blended finance, and I recommend everyone, if you're interested into delving deeper into blended finance concept, to check the OECD website. They have a lot of interesting materials. We used them during drafting of our technical report. And OECD came with idea that blended finance, it's a strategic use of development finance, so a broader concept, development finance, finance which addresses the need for development and SDGs, so it's an easy one, for the mobilization of additional finance towards sustainable development in developing countries. Sustainable development in developing countries. It attracts commercial capital towards projects that contribute to sustainable development. Um, uh, a tricky definition, because in order to serve as an umbrella to cover a broad range of types of transactions, they sort of expanded it way too broad, and it became a catch-all definition. So we can use as anchors aspects of sustainable development, developing countries, development finance, but still OECD definition is a very broad one. I personally like convergence definition. It's an NGO very active in blended finance sphere. They produce every year a report, a state of blended finance. So I used the previous year report, but they published a few months ago a new version of report, and one is specifically dedicated to green finance in connection to blended finance. So very interesting to read. And Convergence believes that it's the use of catalytic capital. Catalytic capital meaning that capital which ignites the further activities. It's when you serve, for instance, as an anchor investor, and private investors knows that you have a solid and sound framework for assessment of project in place, and if you participate in that project, it means that it's safe for them to participate as well. So the risks are lower, and Boitumelo voiced it in the beginning that de-risking is a very important part of blended finance. And for me, as a representative of DFI, the definition of DFI working group on blended concessional finance is a very important one because it's a very specific, combining concessional finance, again, concessional finance from donors or third parties alongside DFI's normal own account finance. So we as DFIs have our own finances, which may be not concessional, but the whole purpose of these finances is to be channeled to achievement of SDGs and the development goals. So principles, there are basically three main sources of, principles for blended finance. It's OECD principles, it's G20 principles, and it's DFI Working Group on Blended Concessional Finance principles. These principles, they sort of interconnected, and they may be seen as um, well, as interconnected. That'll be the right way to say. But also we have characteristics which were drafted by IDFC and convergence. So IDFC believes that for blended finance, it's important to have leverage. By leverage, they mean attraction of philanthropic and private capital, leverage to attract. Second, blended finance transaction should have impact. And of course, blended finance transaction on the basis of minimum concessionality should envisage returns. And that's a very interesting aspect. The minimum concessionality means that the participation of public finance should be no more than it is necessary for transaction to happen. Otherwise, it may lead to distortion of market and crowding out effect, and it will lead to market distortions. And we in DFI will always think about not competing with commercial market players and commercial banks, because otherwise it will have a detrimental effect for development of market. So when we conducting blended finance transactions, we always think whether that transaction will or not have a market distortion effect. And convergence, on the other hand, believes that the transaction should contribute towards achieving the SDGs. Well, it's impact in IDFC terms. The transaction expects a yield of a positive financial return. That's the third characteristics of IDFC. And the public and or philanthropic parties are catalytic. That's the difference from IDFC. So the effect of capital from public or philanthropic party has a catalytic effect, which means that the other participants will come along because they know that the capital of first loss, for instance, first loss capital is here, and you have a lesser risk in that transaction. So principles, I won't delve into the detailed descriptions. Anchor blended finance used to a development rationale. I've talked about it several times. Development rationale is very important. If it's not development rationale, then it's not blended finance in context of sustainable development. Second principle, design blended finance to increase the mobilization of commercial finance. Yeah, well, the transaction should be designed the way that the private party will be interested. And again, philanthropic capital usually interested in social impact. Private capital usually interested in returns or lesser risk with a longer term of return, because if we speak of infrastructure, usually the infrastructure projects return is positive for the private party in term of 20, 30, or even more years, like in the concessions in the PPP, and which is why it's important to take into account interests of all parties. So public finance, public party is interested in having infrastructure. Private party is interested in having returns. Philanthropic capital is interested in social impact. And within each capital, there may be several actors with their different interests in outcomes of that transaction. So it becomes very cumbersome to to negotiate interest of all parties, and that is probably the the hardest part of blended finance, to negotiate interest of everyone. Tailor blended finance to local context. It's very important. I mean, for Russia, we have our local context requiring blended finance to be tailored. For South Africa, it may be different. For instance, I don't know, in energy sector, tailoring to tackle load shedding, for instance. So principle 4, focus on effective partnering for blended finance. Yes, that's what I was speaking of. And promoting high standards. And that is interesting because in all principles by G20, also in DFI working group, promoting high standards is always there. So blended finance should promote a higher standard. But I personally believe that these principles, they are not dogma. They are just a reason to ponder. They help you to understand how to draft and outline blended finance transaction. But every principle, these documents which I'm referring to, they are not they are non-binding. They are voluntary, so they may be used on a customization basis. They may be customized to each specific transaction, the principles which you use. So here you can see a lot of the wall of text of principles from DFI and G20. The first to come up with principles was OECD, then DFI Working Group, and then G20. The G20 principles to scale up blended finance were drafted 2 years ago during the Indonesian presidency. So actors of blended finance transactions. Here you can see a list. It's of course a non-exhaustive list of actors because it's quite cumbersome and problematic to list all type of entities which may participate in blended finance transactions. But the general list here on the screen. From on international organizations level, it's of course multilateral and regional development banks, AIIB, African Development Bank, Eurasian Development Bank, etc. And they quite actively participate in financing development projects and infrastructure and in blended finance transactions. So how would blended finance transaction look if we speak of participation of multilateral MDB, Multilateral Development Bank? So part of financing comes from regional budget, part of financing comes from federal budget or national budget, part of financing is a loan from multilateral development bank, and another multilateral development bank, like for instance World Bank, provides technical assistance. So we have a financial instrument of loan from MDB, we have non-financial instrument of technical assistance, we have a public budget from on a regional level and on national level, and we have I don't know, a toll road. And if it's a toll road, then we also will have a private party which will be interested to use a concession mechanism or something similar to have steady returns and steady cash flow. Also on public sector actors side, there'll be national, subnational, and local governments, development finance institutions, bilateral development agencies. Bilateral development agencies, I don't know if you're familiar with the term. So in many countries, there are special agencies which participate in foreign projects. It may be infrastructure projects like the metro in United Arab Emirates, and a French development agency participated in financing, in providing loan to finance that metro in United Arab Emirates, and that case is in the technical report. So USAID, for instance, it's also an example of bilateral development agencies. So sometimes agencies of developed countries, they may participate in development of other countries, providing them loans, but that's partially a political story, and that's out of scope of my speech. Private sector actors, that's a very easy one. institutional investors like pension funds, insurance companies, sovereign wealth funds, commercial investment banks, private equity firms, asset managers, corporate businesses, impact investors. They are all here. And the last but not least, a very interesting part, it's philanthropic and other sort of organizations that may participate as actors in blended finance transactions. It's NGOs. Sometimes NGOs, they possess a very extensive knowledge in some sort of social uh, um, protection or social impact sphere, like I don't know, the gender equality, inclusivity. So NGOs may be a very valuable source of knowledge or technical assistance or implementer of a transaction. So NGOs are very, very useful. Social enterprises, they are similar to NGOs. They actually a subset of NGOs, but also there are a type of social enterprises. It's a business with a dominating social component. So it's business, but with dominating social component. Knowledge institutions, it's universities, all sort of think tanks. They may be also very valuable, for instance, by providing knowledge on how to assess outcomes, results, and have a framework for assessment, to provide a framework for independent assessment of results and outcomes of blended finance transaction. And of course, providers of technical assistance and consulting services. And that's a very important part because blended finance BF transactions, they are so problematic to structure that sometimes it's better to have a consultant, sort of a consultant that may help to draft that scheme. Because what I like in the definition of convergence, and what separates also the definition from PPP is that blended finance is a structuring approach, not an investment approach. So when we speak of a BF transaction, we speak of a structure of how the finances will be blended and channeled towards implementation of project. And key roles. So you see that University of Zurich identifies several roles which may these actors on the left play during the BF transaction. It's initiator, it's donor, it's structurer, it's a beneficiary. But usually, well, on the left, mostly it's not beneficiaries. It's initiators, donors, and structurers. Beneficiaries usually it's a society or someone who will benefit from the implementation of an infrastructure project. So what we have here, it's instruments and mechanisms. So BF, blended finance, it's an approach. It's an approach, and under that approach, we have instruments and mechanisms which may be used in order to channel finances into the project, and also to serve as a mean to blend the finances. And what are the prerequisites for blended finance? First of all, it's market volatility. So a properly structured BF transaction may help to tackle market volatility and hedge some risks. And of course, risk return profile of projects different. And when private party participates, and we know it from PPP, private party may bring its expertise and its framework for assessment, which will help to be prepared to tackle and hedge some risks, and also participation of different actors with their part in proportion of financing the project will help to distribute risk among all the participating entities in the project. Cost of capital, of course, cost of capital is different, and the cost of capital from philanthropic organization, from commercial bank, from government, from state budget would be different. And blended finance helps to have a to attract capital of different cost, and the average weight of cost of capital may be lower when in comparison to using only one source of finance. Viability of projects. Sometimes participation only of government may not be enough for project to happen. Again, in terms of necessity for technical assistance. Blended finance helps to crowd in capital. For instance, there are projects in Singapore, a very interesting project when cash flow from several infrastructure projects scattered around the world. That cash flow, on the basis of that cash flow, using securitization mechanism, bonds are issued, and these bonds they aggregate the cash flow from different assets, and investors they buy bonds and not part of each of in the specific infrastructure project which is scattered around the world, which are scattered around the world, and that allows to crowd in additional capital into financing infrastructure by using the securitization mechanism, and that's also an example of blended finance transaction when you crowd in capital using finance market instruments. Leverage commercial investments, of course, and low financial return, high development impact. That's also very important. And there are three, let's say, main categories which OECD identifies the types of instruments and mechanisms, what purpose they serve in BF transactions: technical assistance, risk underwriting, and market incentives. So technical assistance, that's obvious when MDB or NDB provide goodwill services in order to structure transaction, to provide necessary legal support and other sort of necessary support in order for the project to happen, to be implemented. Risk underwriting is a very important one because it helps to that sort of instruments and mechanisms help to distribute risk, to de-risk, to mitigate risk, to exclude risk. For instance, using a guarantee or insurance, that's the risk underwriting mechanism. And market incentives, instruments, not mechanism, instruments. And market incentives is a very interesting category because regulatory measures, price guarantees, advanced market commitments, awards, prizes, challenge funds, matching funds, impact bonds, all of these market incentives will attract and mobilize private sector to be interested in participating in projects. So that's a way how government may have its say in helping for blended finance transactions to happen. But for me, it was sort of depressing to know that the average size of blended finance transactions according to convergence is 67 million USD wise. So meaning that the size of BF transactions, average size, is not really enough for an infrastructure project, because a large scale infrastructure project usually requires a larger budget. And what is 67 million for I don't know, for a long road or for energy power grid, etc. So that's numbers from convergence. And these studies that we collected during our preparation of technical report helped us to identify that in BRICS countries and in South Africa as well, a variety of instruments are used. Grants, expertise, debt instruments, and equity instruments. But the thing is that what is problematic with BF? With blended finance, usually private sector participants and public sector participants, actors, they tend to use instruments and mechanisms which they are familiar with. It's a sort of a curve effect. It's called a tram effect, a tram line effect. You have in place all the necessary framework and procedures to assess loans, or to participate in equity, or to issue guarantee, and these instruments you're familiar with them. these instruments you know how to implement and apply in practice. And when someone comes with something new like a social impact bond, we have an extensive practice in Russian Development Finance Institution, in State Development Corporation VEB.RF. We have a lot of well, we believe it's a lot of. We have 13 social impact bond projects. It's something very unusual. It's an unusual financial instrument. And when you approach private sector participants and philanthropic organizations, they tend to be suspicious because they are not aware and they are not familiar with that financial instrument. So, according to Convergence, once again, usually traditional financial instruments and mechanisms tend to be more used for BF transactions rather than more innovative instruments. And I wouldn't say that it's bad, but it means that we have a space to for expansion and for probably a better redistribution of opportunities for BF transactions to happen. And of course, challenges and barriers of blended finance. You see there are 4 categories: policy and regulations environment, that's a legal aspect mostly; institutional and coordination framework; knowledge and capacity; market environment. Under policy and regulations environment, usually the problem of standardization. So many countries and many academic specialists and many experts, they voice that problem that there are no standards for blended finance. But you can standardize blended finance to a limited extent. It's not possible to standardize everything, because that's vice versa. That's a very positive thing of blended finance, to be customizable. But because of that customization capacity, blended finance is very costly in terms of executing transaction, in structuring, on stage of design and structuring. So if you want to lower your costs on preparation of BF transaction, then you need standardization. But when you have standardization, you have a limited space for maneuver. Legal principles applying to blended finance transactions. So some countries, and there is an interesting way how to tackle that challenge, is to issue a sort of a statement. It's not a legal document, but it's a statement, like a guidance, which combines all the necessary information on the way how a BEF transaction should be or may be executed in your local context. So that statement may be helpful for the local participants. Of course, regulatory landscape, conservative funding structure, that was I referring earlier to typical and standard instruments which are used, guarantees, loans, debt instruments. That's the main way how BF transactions are executed. Tax and accounting treatment, that also interesting thing, because when you separate BF transaction into 3, if we presume that we have a BF transaction with philanthropic, private, and public capital participation, then each of that capital will have a different treatment. Philanthropic capital will have its own regulation, also in terms of tax and accounting. Private capital will have its own. Public capital will have its own. So these 3 actors will have their own legislation and regulation, the way how they execute transaction, how they channel finance, what kind of agreements they undersign when they want to transaction to happen, and how, from a tax standpoint of view, that transaction is treated. Because we know from earlier slides that blended finance is dedicated to development, meaning that it may be eligible for some softer tax regime. But because of these 3 different sources of capital, the tax regime is mixed. In a way, it's also blended, and we have that ambiguous or vague understanding what proper tax regime should we apply to the transaction overall. Institutional coordination framework, bankable projects pipeline. that's also a G20 priority of South Africa in the next year, and that's a very important one. Of course, it's hard to attract private capital when you don't have a pipeline of projects ready-made, like a marketplace of, of projects. And when we say bankable, we encompass everything. I mean, risk, return, and other aspects of project. Coordination between stakeholders. That's very great that GTAC has such a platform for webinars, for awareness raising, and these sort of coordination and reaching out, outreach platform is very useful for everyone to speak, to have a common ground and to speak on the same language when we refer to blended finance transactions, and to coordinate each other. Dedicated blended finance advisors, I mentioned it. It's very important because sometimes if you want to scale up, you have to increase capacity, you have to have institutional memory, you have to have a history of successful transactions, and sometimes it's good to start with financial advisors to build up your institutional capacity, and then you may leave them out and continue on your own. Accountability to stakeholders, that's also important. What's the effect of that transaction? DFI's involvement, yes, very important. Government action failure, also sometimes we know that due to regulatory landscape, the conditions of transaction may change, and that would be problematic in the end to deliver that project. The data gap and transparency, very important, because sometimes in order to assess the viability and feasibility of a certain project, you need data, and that data should be disclosed and open. And apart from having a pipeline of bankable projects, we should possess some source of data for private sector and philanthropic capital, patient capital, to be able to understand what's the parameters of the project, what's the history of similar projects. Knowledge and capacity, it's obvious. Awareness raising, partially that's what we are doing today. Awareness raising, a crucial aspect, I believe. The challenge of shifting mindsets, yes, it's important. The main problem is that still the interest rate and interest in return is higher than interest in development or developmental impact. So it's important to shift mindset to make development impact more important than the return rate. Local government capacity, of course, in Russia, for instance, we have a different capacity on depending on level. So municipal capacity is not equal to regional government capacity, and regional government capacity not always equal to federal government capacity. So it's important because blended finance transactions, because of size that I have mentioned earlier, if it's not a large scale transaction, sometimes on municipalities and on local government, everything lies on their shoulders to implement the transaction, and they should have necessary capacity in place. Lack of well-planned projects, that is also maybe attributed to pipeline of bankable projects. Understanding the opportunities, challenges, risks, and transfer mechanism. Yes, to understand what's pros of blended finance transactions. That's a challenge and a barrier. Confusion between addition and additionality. So additionality, it's a very important concept within the blended finance. Additionality means so the question that helps to understand what is additionality. Additionality answers to the main question: would that transaction happen if not for the participation of that capital? Yes or no? So additionality is specifics that MDB or DFI brings into that transaction. For instance, if not for participation of World Bank, if not for participation of Development Bank of South Africa, that road wouldn't ever been built, because they provided technical assistance, concessional capital. Also, they provided a platform for coordination of all stakeholders. So that's an example of additionality. And market environment, it's a very important one because mismatch in risk appetite. For instance, in Russia, we have a high key interest rate now, and people tend to put their money into deposit, not into finance market, because the interest rate on deposits are so appealing that they don't want to risk, and they use a conservative instrument. And that's the problem, because sometimes, and we know with the infrastructure projects, the initial stage is the most risky one. So you need something which may help you to bridge that the riskiest riskiest stage of development of implementation of infrastructure project. And of course, if someone takes um, a first loss during that first stage of infrastructure projects, it makes more appealing for private sector to participate. Prioritization of financial return, that's a challenge. I've talked about it a lot. Exit strategy, it's for the equity participation. When you participate in equity, in capital of a, for instance, a special purpose vehicle, you have to understand what's the exit strategy for private sector or for public sector, when to leave that legal entity which was established for the project. So what's the exit strategy from the project? Avoiding market distortion, I talked about it. Availability of long-term local and hard currency financing, that's a very important one, because local currency is always more appealing to use in order to mitigate foreign exchange risk. Bond market maturity, it is also related to availability of long-term local and hard currency financing. High transaction costs, yes, blended finance, it's still case by case. It's not a pipeline of blended finance projects, or like a typology or album or taxonomy of blended finance. Limited toolkit, yes, debt instruments, equity instruments, and bankable projects. So conclusions. The BRICS countries are generally familiar with blended finance approach, including South Africa. And the treasurer of South Africa, our esteemed colleagues, they have a very good understanding of blended finance, and I have to admit that South Africa published a lot of interesting materials related to blended finance. So you're using that approach quite extensive. But countries have a varying degrees of sophistication in using it to finance infrastructure projects. So for some countries, it's just simple PPPs. In other countries, we have a complex structures. For instance, the next one, which the next presenter, Veron, will tell you of a very complex structure, sophisticated one, and a very effective one, and interesting in terms of using blended finance, and with a high developmental impact. The most influential and promising actors in blended finance, MDBs and DFIs, and including national development banks. When we speak of DFIs, it's not only national development banks, it's also export credit agencies, it's also specialized funds, specialized facilities, which may not be in form of banks, but they still provide concessional and other sort of development finance. So the most common blended finance instruments used by BRICS countries are debt instruments, mechanisms, PPPs, funds, and facilities extensively used. The main challenge is for the blended finance scaling up is regulatory sphere and market environment. Yes, we need legislation in place. We need regulation in place. We need to understand with the tax regime, with accounting, and we need to understand what to do with the standardized forms of legal tools and legal means used to bring everyone to the table. And the BRICS countries have potential to develop blended finance approach further. So we have interbank cooperation mechanism of development banks with the DBSA participation as well, and of course, new development bank as part of BRICS, initially part of BRICS, may be very helpful. So thank you. I have tried to be brief. I hope that was really interesting, and I'm looking forward for Veron participation and presentation, and I'm looking forward for your questions. If I will be in place and positioned to answer them, I would be happy to do so. And again, thanks for having me here. That's a very great opportunity. I stop here.
Thank you, Vadim. So I will take colleagues through the presentation Vadim was referring to. So this is more an application of blended finance and how that was done in South Africa. Okay, so I'm taking you through the Olifants Management Model Programme. So many of you might know this as the Olifants River Water Resource Development Programme, which was conceptualized by the Department of Water Affairs in late 2000s, and that was to solve for water supply issues in the I think it's called Middle Olifants River catchment area, and that's in Limpopo. So what this program is, it's a source to tap solution. So it's a water program that seeks to provide approximately 263 million cubic meters of water per day to commercial users and institutional users. Institutional users, it means municipalities then supply, the people that, the residents, the communities that they serve by 2050. So the submission was mainly in relation to phase 2B and 2B+, which was a raw water pipeline project that aimed to deliver 95 million liters of water per day. The objective of the program or the project was to improve the reliability of water supply and cater to the unserved. So what was found was that about 10% of the households within the communities that were served by this by the river were low income, and low income were 50%, and the ones that were unserved completely were 10%. So it was to make sure there's water reliability, and then those that were not excluded were also served. And the beneficiaries were plus minus 20 mines, businesses and communities in Polokwane, Sekhukhune, and Mogalekwena municipalities. And those municipalities are the municipalities that are part of the catchment area. And obviously, there's a lot of mining activity around the area, so mines also stand to benefit, including industry. As mentioned, this is in Limpopo. And the investment for the project specifically, that's 2B, phase 2B and 2B plus, is 6.3 billion. And the program as a whole, so this whole to 2050 situation is going to cost 26 billion. And for the project, which is 2B and 2B plus, the construction period was estimated from 2025 to 2027. And it was going to be delivered through an EPC contractor, which is the engineering, procurement, and construction contractor. And where the project currently is, so this is a recent project and it's not yet in construction, it's in financing, and financial close is expected to be reached by March 2025. And that is good for context, so you understand where it is and what it's trying to do before we go into the blending. So in terms of the blending approach, the infrastructure fund was approached by the Department of Water and Sanitation to help them structure the project. So it was obviously identified as a potential blended finance project, and the infrastructure fund, which we might know, was established in 2020 with seed funding of 100 billion to attract or catalyze 1 trillion in private capital. And what they did was they structured the financing in such a way that would see commercial lenders, so these are your banks or whoever might be keen on or interested in participating, to bring in 3.4 billion of the 6.3 billion, or that's 55% of the total cost, and public funding of 2.9 billion, which is equivalent to 45% of the cost. And obviously with the public funding, that came from various sources, right? So the water trading entity contributed 461 million through its grant, right? So that's public finances. We also had the infrastructure fund package the submission for consideration by the BFI. So if all the blended finance transactions that come through the infrastructure fund have to come to the Treasury through the BFI appraisal process for consideration. And well, if that process goes well, then approval for the money to be allocated in whatever way is deemed appropriate. So through the BFI, a grant of 1.4 billion was extended to the project, as well as a concessional facility through the IF. So this is the bit that was meant to cover institutional investors. So the idea here is that municipalities' balance sheets were constrained, and one, they would have to borrow at very high rates. Two, they may not be able to borrow. So what the IF did was offer a loan facility, obviously through the fiscus, of 1 billion to borrow on municipalities' behalf, or that will be paid back though. So that's how it was structured. So there's a lot of actors, as you can see, and as Vadim has highlighted, with blended finance, you get a lot of players and a lot of actors and a lot of instruments that come in for the money to be pulled to move forwards the projects forward. And in this case, there was a lot of elements that came into play on who and why they were coming into the project. For example, the BFI was coming into the project because there was a lot of social element. If you remember earlier when I started, we have 30% of indigent users in the municipality, and I said 10% were also uncovered. And of all the users or potential users that are going to come in, 50% of them are low income. So there's a lot of subsidization that needs to happen. So that social element is what the BFI was coming in for. And what the IF portion was coming in for was to obviously ensure that we uphold the user pay principle and thinking about the pricing and subsidization policies and, you know, raw water pricing policy and regulation as well. So what the IF did was to extend this loan facility so that, you know, the portion that was meant to be contributed by the institutional investors, which the municipalities, was sort of fronted by the IF and in an arrangement that they would pay back later. So collectively, these instruments presented a bespoke blended finance solution that allowed, one, for the indigent users to be catered for, and also just to almost alleviate a situation where there is guarantees needed from the fiscus. So this is how the arrangement went, and there's a lot of arrows and numbers, and I'm hoping I'll make this very easy for people to follow. So this also shows you how many people were involved, and, you know, the arrows shows you where the complications around arrangements that were in place and how, you know, the interfaces between the different players and how they come together. So first you have the National Treasury, which is where the Department of Water and Sanitation came to for fiscal support. And as I mentioned, this was for both a grant, right, and also the facility that the IF would extend. So normally how Treasury will determine flow of funds based on, you know, the regulations that are in place, PFMA, and money follows source typically. And this is what happened. So with the funding that was approved, it was channeled to the department and the water entity, trading entity, and then that was sent to the SPV, which is I get the name wrong, Lebalelo Water User Association, which is what was responsible for the drawing funding from the private sector, but also implementing the project. So that money was channeled there. And with the institutional off-takers, these are the municipalities that serve communities, and commercial off-takers at the mines and industries, and those agreements have been signed, they would then pay the SPV for, obviously, the water that is supplied to them. So it's through user tariff payments, and they would collect this money that they got from the Treasury back to the IF, because some of it was sort of extended through IF, but the IF would also have to pay back the money. Well, in Vadim's analogy, he talked about parents that extend a loan to their children because they want to be close. So in this case, the children will have to pay back the parents. Yes, there is no interest in this case as well. So Treasury is the parent. So with the SPV being here, they have to pay back the money they got from for payback for the facility that was extended through the IF, right? The grant is a grant, so it doesn't get paid back. But there was also a need for that 3.4 billion. Here it says 3.1, it's actually 3.4 billion that was going to be received from commercial lenders. So that is also paid into the SPV, which all the pooling would happen here, and the SPV would work with the IF to just ensure that everything comes together. So the SPV would also be responsible for the operations and the maintenance of the project, and would have a separate contractor for the building itself. So this is how everything came together. So you have money flowing from different institutions to serve a different purpose, and everybody plays their role, and everybody interests are catered for, and at the end you have a project that delivers water to the communities that need them the most. And that's how the structuring was done on that project. And yeah, this is me. Thank you.
All right. Thanks. Thanks. Firstly to Vadim for the the comprehensive presentation on what blended finance is, what the different actors are, or who the different actors are, and how structures generally work across the BRICS countries, and to Veron for applying a specific project on how blended finance was done. And I'm actually is it Vivek is here? Vivek is online. He was the lead assessor for the OMMP project. And I think I also saw Miriam from Infrastructure South Africa, and I know that she was involved in the assessment of that project. So as and when there are specific questions related to the OMMP, they would be in a more privileged position to answer some of those. So, I mean, at this point, I would just like to open the session up to questions, but also to comments that people would like to make based on the two presentations that they have had. So if anyone has a question, please feel free to raise your hand so that we can recognize you. And thereafter, we will give you an opportunity. There has been some questions on the chat, and maybe what we can do is, was it Brian? Brian was asking about the interest on the commercial lender, or from the commercial lenders in the project. And the response is that the project has not reached financial closure yet. So the process of raising finance is still ongoing. So we don't know what those, the cost of capital is going to be eventually when the project closes. So that's the one question that I saw. And I also know that the report will be shared with the colleagues on the GTAC website, Knowledge Hub. On the GTAC Knowledge Hub. So I think that also answers that question. Elaine, I see that your hand is up. You are recognized.
Thank you, Chair. Right, my question is about risks of exploitation, the risks involved around exploitation, and specifically from the BRICS as a collective. You spoke about challenges and barriers and tools and mechanisms. It's not 100% clear to me whether those tools and mechanisms form part of the BRICS as a collective, and whether it's provided through one of your institutions, whether the Interbank or the New Development Bank, as support to countries doing blended finance. So for me, I would be interested to understand to what extent does BRICS provide the type of support that protect, in a sense, your beneficiary. Like, if I give you just a few examples that come to my mind, one would be around social and environmental costs. Private funders might actually prioritize profit over social or environmental impacts, and not because it's such a sophisticated sphere. Your so-called beneficiary or the person who needs the money might not understand how to negotiate this. Something else would be the unequal bargaining power. In my previous life in development, low income and many developing countries, the local negotiating capacity might not be the same as that of the funder. So you might be exposed to excessive fees or privatization requirements, etc. A last one would be, and it's also a question to Veron then around risk sharing. So there might be negotiations that provides disproportionate benefits to your private funders, where they capture most of the financial returns, and your other parties, they bear the majority of the risks, the government. And once again, in your developing countries and your low-income countries, that might be a real risk. And my question would be, as BRICS, do we provide this service through any of our banks or bodies to the BRICS members, so that playing ground is a little bit more equal? And then I have just one other, just for interest, question, very brief question. So Veron, I wanted to ask on the Olifants project, the risk sharing structures, whether South Africa has a risk sharing structure or is it case by case? How do we determine that? And then just a general question, Boitumelo, to you, Vadim, and the team. I'm interested to understand, when you look at the Bretton Woods, or you look at OECD and you compare them with BRICS, and how these, let's say Bretton Woods and OECD, we put them in one camp and we put BRICS in another camp. What is the difference in terms of what we prioritize or what we see as critical when it comes to blended finance? Thank you.
Thanks, Elaine.
I can start, and Veron, you can continue. So starting with the difference between BRICS, OECD, and you said Bretton Woods. So OECD, it's an international organization. Bretton Woods institutions, they are also an international organizations. While BRICS, it's like a G20, a club of states where countries of a similar mindset, of similar view towards how the world in certain spheres may prosper and evolve, discuss with each other, and in a political commitment documents, publish their view every year, like in Declaration of Leaders. So when you refer to provision of services by BRICS, it's not a correct way how to put it, because BRICS, it's an interstate fora for dialogue. But when you refer to provision of services within BRICS or under umbrella BRICS, for instance, the former New Development Bank, which had that BRICS title for some time, now it's broader than just BRICS. New Development Bank provides loans, technical assistance, and other sort of, I don't know, policy-based financing for, if they have such an instrument, probably they have, but anyway. So multilateral development banks, they provide a lot of instruments, and they utilize a lot of instruments and mechanisms that may be used within a blended finance transaction. But when it comes to bargain power for multilateral development banks, bargain power is not that important aspect, because they were established to finance development of emerging markets and developing economies. And when New Development Bank provides sovereign loans to South Africa, for instance, or to other countries, that is the way how they fulfill the reason for their existence. And it's not about the bargain power. But when it comes to participation of private party and if it's a project that should be financed through with the composition of finance would be a combination of public and private. Yes, that's an issue when private party is willing and ready to provide finance only when the return rate is appealing, only when the risks are low. That's the way how entrepreneurship and business works, which is why now the ESG, the SDG, the other sort of sustainable development regulations and regulatory landscape is developing, because that's the way how to channel the activities of business to be mindful of social and environmental aspect. And that mindfulness at some moment may be overweighting, may weigh heavier, be heavier than the interest in return rate. And of course, it starts for me. I've been a public servant for many years, and it starts when there are fines or other sort of leverage, when business understands that if I won't have some sort of, if I won't do some, let's say, I don't know, if I won't support environmental projects, I may not apply for a support scheme. For instance, that's a market incentive from government. If you support environmental projects, then you're eligible for some support from government. That's an example. But that's the thing with blended finance, when you need to combine actions from government on regulatory landscape, you need to combine interests of private parties who is interested in income, and you combine philanthropic capital, which is interested in maximization of social impact. I hope I have answered your question. So Veron, if you have to add something, and Boitumelo.
Yeah, maybe let me come in first. Building on what Vadim has said, the beauty of blended finance is that you have many actors. And often there's this obsession. It's not unwarranted, but there's a big obsession around unlocking private capital, particularly coming from institutional investors such as pension funds. But the reality is that in order to even get to that stage of unlocking private capital, there's sort of the middle part. And that's the role that a lot of IFIs, international finance institutions, and more specifically MDBs play. And that's where the World Bank, the New Development Bank, and several other banks sit, of course, including even local DFIs and so on. And the reality of it is that capital is mobile. So as a country, you also don't have, well, certainly as far as I know, we don't have a position that says this partner is more important than this one. But I think we have a kind of a framework that acknowledges that different partners come with different tools and instruments and so on and so forth. But secondly, they have a different risk appetite. And for that reason, you can't give your entire share to one and leave out the other. So it's really about how you optimize this, pooling of funds from different sources, depending on the project that you are looking at. And I think what the BRICS countries have been saying, in as far as the New Development Bank is concerned, is that because it comes from a developmental perspective, it understands the issues a lot more than what some of the international organizations, specifically the Bretton Woods institutions, would be able to understand. So I just wanted to build on that point. The second point that I would sort of want to make is around risk return profile. The reality of infrastructure in a lot of instances is that this is not free money. Capital is quite mobile. So you do need to pay people back, right, for the money that that you use. And the reality of it is also that depending on the type of structure that you have, people are able to tell you that this is the extent to which we can take these kinds of risks, and depending on how much risk you take, then the return should be, almost concomitant with that with that risk. But I do accept your point, Elaine. In a state such as South Africa, and I can only speak for South Africa, where the capacity of the state and the capability of the state is so weak, the ability to negotiate contracts, it's almost usually biased against the state. Because from the financial sector, they bring out the best of the best. And in our case, not that we don't have the best of the best, but the best of the best may be doing 7 other jobs. So firstly, they don't even have time to apply themselves. Secondly, they have gaps of their own, and so on and so forth. And that's where, Elaine, for example, I don't know if our colleagues from the PPP are here, but one of as an example, the PPP unit in the case of PPP project, they would sit there with the sponsor during the negotiation process to ensure that government is not necessarily exploited. And maybe the last thing that I want to say specifically in relation to the OMMP is that the way that the project is structured, on the one side, you've got an implementing agent. That's the Water Use Association, which has now become the SPV. And this SPV, naturally, I mean, it's a water use association. It's going to sort of delegate down or cede some of its responsibilities. So you do have an EPC contractor that is coming in, and because it's an EPC, it's turnkey. So you are limiting the risks within the EPC contractor. Of course, you have to pay for the fact that there are a lot of risks that they have to manage. And then in terms of how the risk allocation happens, the principle out there is that you allocate the risk to the party that is best able to manage that risk. Unfortunately, again, based on our own experiences, we know that in the case of South Africa, we haven't necessarily done it efficiently in some of the projects, but the principle, remains what it is. And maybe I should stop here for now and give Veron an opportunity to also come in before we quickly close.
Thanks, Boitumelo. You've said exactly what I needed to say on the risks. And and on the BRICS is obviously each country's interest to strengthen their institutions and the capacity within the country to be able to, one, negotiate contracts, whether that's risk sharing or the terms in which financing from the private sector is being given. So that's it. And maybe to just end up is in South Africa, some of the issues we are having with blended finance is the fact that there's a lack of dedicated mechanisms that ensure a smooth flow of funds, knowing who we're supposed to have agreements with, how the money is supposed to be channeled and come back. And those are the issues we're still grappling with because it is a relatively new concept for us. So I'm good. Thank you.
All right. Yeah. So colleagues, thank you very much. I see that there are two other questions. Comments and there's also a hand, but I do need to close. So the questions that are on the chat, we will respond to them on this channel. We'll do it in writing. I do want to take Brenda. It will be quick, depending on how complex the question is. We may also come back to it through the chat rather than responding to it here. Brenda, please come in.
Thanks, Boitumelo. I'm just curious if part of these developmental finance frameworks also touch on some kind of framework that attempts to rank strategically what the social projects that are worth investing in, because I do find that, say, for instance, in the SOC space, the motivation is usually job creation. which is quite vague and quite universal. Anyone can come up with that as motivation. So I'm just wondering then if there are frameworks perhaps that are advanced and developed that try to assess and put into a matrix what would be meaningful to recommend for these project financing and to support from this perspective. Thanks.
Thanks, Brenda. You were the last person from the floor. I do want to take this opportunity and really thank the colleagues for attending the session. As I said, we will come back on your question, Brenda, but also the other questions that we have not responded to in writing. So do expect a response quite soon, actually. So yeah, thank you very much, colleagues, for attending the session. And because this is the last webinar for the year, we really thank you for having been with us on this journey on very useful webinars throughout the year. And we hope that in the new year you do still attend these sessions and that you find them useful. If you have suggestions around topics that you would like us to consider, please reach out to Anita, who's the convener of these sessions together with Nobuntu, and we can see if we can source the relevant experts to come and help us with these things. If we don't speak again, please enjoy the festive season. We shall see each other next year. Thank you very much. Vadim, Veron, thank you.
Thank you.
Thank you. Thank you,
Bye-bye,
everyone.
everyone.
Bye.
Bye. Thank you, colleagues. Bye.
Bye. Bye.